Subscribe to my channel Report Stock.
Welcome to the Deep Dive, where we cut through the noise and pull out the most important insights from a stack of sources just for you. Today, we're diving deep into Workday's recent Q2 fiscal 2026 earnings report. This isn't just about crunching numbers, it's about what those numbers reveal about Workday itself and, well, crucially, the wider tech industry landscape. Our mission is to extract those crucial nuggets of knowledge, making complex financial and business insights accessible and hopefully truly thought-provoking. Okay, let's unpack this.
Exactly. And our journey today goes beyond simply, reporting Workday's headline figures. While their performance is certainly a major talking point, we're aiming to place it in a much broader context. This deep dive will include some, potentially surprising insights gleaned from analyst ratings and a comparative look at how other industry players are performing. Our aim is to give you a really comprehensive understanding of the intricate forces at play in this dynamic sector.
Okay, so let's dive right into the headline figures then, because Workday, ticker WDAY, didn't just meet expectations this quarter. They absolutely crushed them. They delivered what you can really only describe as a stellar Q2 fiscal 2026, blowing past Wall Street's expectations on both their bottom and top lines. We're seeing truly impressive overall revenue growth year over year, a clear signal of their market momentum. But what exactly is fueling that acceleration? Our sources point to solid customer wins, continuous innovations, some very smart AI integrations across their platforms, and a significant push into international expansion. It sounds like they're executing on multiple fronts with real precision.
Yeah, they really are. And what truly stands out about this performance is the depth of it, right? It goes far beyond just squeaking past estimates. Workday's non-GAAP net income per share hit $2.21. Now, for those maybe less familiar, non-GAAP figures are what companies often use to show their core operating performance. They strip out things like stock-based compensation, non-cash stuff. Gives a clearer picture of their everyday profitability, and it's a number analysts really key in on. So this $2.21 is a significant jump from $1.75 in the prior year, and notably, it beat the Zacks consensus estimate by a solid 12 cents. That's quite a beat.
12 cents is definitely noticeable.
Yeah.
And the top line.
Right. On the top line, net sales reached $2.34 billion. That's up from $2.08 billion year over year. And it beat estimates by about $8 million. What's fascinating here is this wasn't just incremental growth. It was a significant step up. It clearly indicates robust and actually increasing demand for their human capital management and financial management solutions. And that's in a highly competitive market, mind you.
Those numbers certainly look strong. Yeah, painting a vivid picture of market traction. But what specifically is driving this momentum beyond the headlines? Are there any, subtle indicators we should be reading between the lines here?
Well, our sources give us some pretty compelling examples of where that traction is coming from. They secured new customer wins with major names. Think global retailer Carrefour, healthcare provider Memorial Health, packaging giant Smurfit Westrock, and financial institution Banamex. Big names.
Okay, so serious players signing on.
Exactly. And it's not just new logos. They expanded existing agreements with powerhouses like pharmaceutical giant Sanofi, aerospace company Blue Origin, and, Google.
Wow, Google too. That's significant.
It is. And the reach is also incredibly diverse. Workday's solutions are clearly resonating across a really wide array of industries. We're talking education, healthcare, financial services, retail, hospitality. This isn't some niche player. It's a broad-based appeal that I think suggests fundamental strength in their offering.
Makes sense. That diversity must give them some stability.
If we connect this to the bigger picture, it's crucial to look at the composition of their revenue streams. Their subscription services revenues, which are the absolute core of their software-as-a-service business model, contributed a massive $2.2 billion. That's a healthy increase from $1.9 billion. This is excellent news, right? Not just because subscription revenue is inherently recurring and predictable.
The sauce holy grail.
Precisely. But that stability gives Workday incredible leverage to reinvest aggressively. Think R&D, strategic acquisitions. Knowing they have that solid revenue floor, it allows for a much more confident long-term growth strategy. Now, professional services revenues, on the other hand, typically for implementation, consulting, that sort of thing, came in at $179 million. That's a slight miss compared to the prior year's $182 million.
So, okay, a small dip there. Anything to worry about?
Probably not a major worry. It's a smaller part of the total. Perhaps suggests some optimization in how they deliver or price those services. But what truly reinforces their future performance is the subscription revenue backlog. The 12-month backlog stands at an impressive $7.91 billion. That's up a strong 16.4% year over year, largely thanks to higher contract renewals.
So customers are sticking around and committing for longer.
Exactly. And the total subscription revenue backlog, looking further out, reached $25.37 billion. That's up 17.6% year over year. These backlogs are just powerful indicators of future locked-in revenue and robust customer stickiness. Customers are signing on and they're renewing.
That backlog really is a testament to the confidence customers have, locking in that future revenue. It suggests it's not just about winning new business, but keeping it, growing with clients. And beyond the revenue, their operational efficiency looks incredibly solid too, right? Non-GAAP operating income climbed to $680 million. That's a 29% margin.
A very healthy margin, yeah.
Our sources point to this being a direct result of, quote, revenue outperformance, ongoing cost discipline, and improved efficiencies across the company. It really sounds like they're managing this explosive growth very smartly, converting that top-line success right into bottom-line profitability.
Indeed, and that discipline extends to their overall financial health. It paints a picture of real robustness. Workday generated a substantial $616 million in cash from operating activities in Q2. That's up from $571 million last year. This strong cash generation means they have significant financial flexibility. Think of it like, a well-managed household budget, consistently bringing in more than it spends, leaving plenty for savings or investments.
A good analogy, so they have options.
Definitely. As of the end of July 2025, they had a robust $8.19 billion in cash and marketable securities against just under $3 billion, $2.98 billion in long-term debt. This demonstrates a very healthy balance sheet. It suggests they are exceptionally well-positioned for future investments, maybe strategic acquisitions, or even just to weather any economic shifts. It provides a strong cushion.
Okay, so far, Workday's report paints this picture of a company just hitting all its marks, firing on all cylinders. But as we often find on the deep dive, the story is rarely, well, quite that simple. Now, let's turn our gaze to their own crystal ball. What does Workday itself predict for the future, and what might that tell us about the market's current perception?
Right, the forward-looking statement. So for Q3 fiscal 2026, they're guiding for subscription services revenue to be around $2.41 billion. That would represent about 12% growth year over year. Professional services are estimated at $180 million, roughly flat, and they anticipate a non-GAAP operating margin of 28%, still quite strong.
And for the full year, fiscal 2026.
Looking at the full year, the projections are even more comprehensive. Subscription revenues expected around $9.51 billion. That indicates about 13% year-over-year growth. Professional services around $700 million for the year. A non-GAAP operating margin holding strong at 29%. And operating cash flow forecasted to be a substantial $2.85 billion. They even gave guidance on capital expenditure around $200 million, which is actually slightly down from fiscal 2025, and a non-GAAP tax rate of 19%. Very detailed outlook.
Seems like confident projections across the board.
What's fascinating here is that these consistent growth projections, especially in those critical subscription revenues, signal a company that anticipates continued strong demand and market penetration. That's in a highly competitive SaaS space, remember. They're not just resting on Q2.
Yeah.
They're confidently mapping out a positive trajectory, which typically would reassure investors quite a bit.
Okay, sounds standard so far,
Okay.
but I sense a but coming.
Well, here's where it gets really interesting.
Okay, you've piqued my interest. What's the unexpected twist here? Lay it on us.
Even with all these undeniably positive indicators, the revenue beats, the strong backlogs, healthy cash flow, optimistic future guidance, Workday currently carries a Zacks rank #4. Now, for those unfamiliar, Zacks Investment Research ranks stocks from 1 strong buy to 5 strong sell. #4 is their sell rating.
A sell. After everything we just discussed, how does that work?
Exactly. Essentially, their proprietary system suggests the stock is likely to underperform the broader market in the near term, despite the company's strong operational performance. This raises an important question. How can a company with such strong earnings and a positive outlook receive a sell rating? And what does this mean for you, the listener, when you're evaluating company performance?
Yeah, what's the disconnect?
It really highlights the importance of looking beyond just the surface-level numbers. This isn't just vague sentiment. It often boils down to a few key things, like, has Workday's stock price already run up so much that analysts see limited future upside, even with continued good performance?
So the good news is already baked in, maybe.
Could be. Or is the stock simply considered overvalued compared to its projected growth rate? Maybe those growth rates, while impressive, are actually decelerating even slightly compared to prior periods. Sometimes that spooks the market in high-growth tech, even if the absolute numbers are still fantastic.
Right, expectations are everything in tech.
Totally. Or maybe there are emerging competitive threats, perhaps from a nimble startup or a tech giant expanding into their space that aren't yet visible on the quarterly numbers but concern analysts about long-term market share. It's a reminder that a strong company, in terms of its underlying business, isn't always reflected in a straightforward way by every single stock metric or analyst rating at a given moment. It's often about relative valuation and those future expectations.
That brings up such a critical point about how value is truly perceived in the market. If Workday, with all these strengths, gets a sell rating, what does success even look like to analysts right now? To really unpack that, maybe let's shift gears. Let's see what other companies in the broader tech landscape are currently getting those coveted buy ratings and what strategies they're employing. This might offer a useful comparative perspective, highlight some different pathways to market leadership.
Exactly. That's a great idea. Let's introduce 3 better-ranked stocks that present diverse approaches to market leadership, all currently holding a Zacks rank #2, which is their buy rating. First up is Ubiquit Inc., ticker UI. They delivered an impressive 61.29% earnings surprise in their last reported quarter. Huge beat.
Wow, over 60% surprise. What's their secret sauce?
Their key strategy seems to be a relentless focus on significant R&D investment. They're pushing hard on innovative products and technology. This isn't just about incremental improvements, it's about genuinely expanding their addressable market with new offerings and driving higher average selling prices, AFPs, for premium cutting-edge solutions. They're seeing healthy traction specifically in their enterprise technology segment, which really underscores their ability to innovate and capture value in demanding professional markets. Ubiquiti's approach is a clear example of winning through innovation and offering differentiated high-value products.
Okay, so Ubiquity is all about pushing the envelope with R&D, commanding premium prices. That's one clear strategy. What about our next example? Who's next?
Next, we have Jabil, Inc., ticker JBL, also carrying that Zacks rank #2. They showed a 9.44% earnings surprise in their last reported quarter, solid, if not as explosive as Ubiquiti's. Now, Jabil, as a manufacturing services company, really exemplifies diversification as a core competitive advantage. This is interesting. They have this incredibly disciplined internal target. Basically, no product or product family should be greater than 5% of operating income or cash flows in any fiscal year.
Only 5%. That's
No.
intense diversification.
Really is. Think about it. It's a unique, proactive risk mitigation strategy. It forces them to constantly seek new opportunities and prevents over-reliance on any single, potentially cyclical market. It's like building a house with many different strong foundations, right? So if one starts to settle a bit, the others still hold strong. This approach can lead to steadier, more predictable growth, appealing maybe to a different kind of investor than one chasing pure hypergrowth in just one sector. It highlights resilience through strategic breadth.
Diversification as a bedrock strategy for long-term stability and mitigating risk. That's a powerful model, definitely different from Ubiquiti's focus. And the third one, how are they finding success?
Our third example is InterDigital Inc., ticker IDCC, another Zacks rank #2 company. They boast an impressive average earnings surprise of 54.27% over the trailing 4 quarters. So consistent outperformance.
Okay, sustained high performance there. What's their angle?
InterDigital's success seems to stem from its global footprint, a diversified product portfolio, and aggressive market penetration, primarily through intellectual property licensing. Their strategy includes actively pursuing agreements with unlicensed customers, especially in the massive handset and consumer electronics markets, getting everyone on board. And beyond their strong wireless tech solutions, they're also strategically adding new technologies. Think sensors, user interface tech, video to their offerings. They're eyeing the huge market potential and new revenue streams in those evolving areas. This company seems to win by leveraging its R&D into a broad IP portfolio and then licensing it widely, constantly looking for new applications and markets for its innovations.
So what does this all mean? We've got Workday with stellar numbers, but this puzzling sell rating. Then Ubiquity driving innovation and premium value. Jabil focusing on broad diversification for stability. And InterDigital expanding its global reach and tech portfolio through strategic IP licensing. How do these diverse strategies illustrate the different pathways to success in tech, and what crucial insights can we gain from comparing them to Workday's approach? It really highlights that there's no single recipe for success, doesn't it? And how success is perceived can vary wildly depending on the lens you're looking through, whether it's raw growth, profitability, market share, or that tricky relative valuation piece.
Precisely. We've seen Workday's incredibly strong financial performance driven by customer growth, AI integration, solid operational efficiency. Yet it's paired with this sell rating from Zacks that prompts us to ask deeper questions about valuation and future growth expectations. Then we explored the varied yet successful strategies of other highly ranked players like Ubiquiti, Jabil, and InterDigital, all thriving through different means, right? R&D and premiumization, broad diversification and risk mitigation, or IP licensing and market expansion. It's just clear that strong earnings don't always tell the whole story. Market rankings often reflect a complex interplay of current performance, future outlook, broader market conditions, and crucially, how much growth is already priced into a stock.
Absolutely. This deep dive really shows that the tech landscape is dynamic, it's multifaceted, and it demands a really nuanced understanding. It's definitely never as simple as just good numbers equal a good stock recommendation.
So, considering Workday's impressive financial results, but that sell rating, and then the varied successful strategies of its highly ranked peers, here's something to think about. What balance of current performance versus future potential versus valuation versus diversification do you think defines a truly strong company in today's rapidly evolving tech landscape? It's a question worth pondering because how you weigh those different metrics can fundamentally change your perspective on what makes a company truly strong.
Subscribe to my channel Report Stock.